What is up, investors? Back again. Another viewer's choice on this one. Today, we're going to take a look at the Kraft Heinz company, ticker symbol KHC. And now, this is an interesting company. So, we're going to talk just broadly about the company and some of the brands that they have. We're going to take a look at some historical earnings, get a picture of, why has this stock kind of gone up and then has come down fairly rapidly here, and then we'll jump into the latest quarter here and take a look at what's going on. We're going to look at stuff like balance sheet, statement of cash flows, all those kind of things. Now, this company does pay a dividend, and something I've never talked about on this show is actually dividend coverage, or the ability for this company to keep paying this dividend. So that'll be an interesting thing to talk about in the future. So let's just broadly, whenever I take a look at a new company, this one has been on my watch list. I can't remember if I put it on my watch list at this drop, or I think it was probably this drop where I put this on my watch list, because anytime a really well-known company goes from about 50 to share all the way down to about 30 in basically a day or two, definitely is something that I want to take a look at. So appreciate the viewer of our channel that recommended this. If you have a stock you'd like me to review on the show, on the channel, leave me a comment below. I've got a couple in the queue, but I'd be glad to get to it very soon. So here we go. Kraft Heinz company trading about right at $30 per share, but we've noticed, I think they had a merger back here somewhere, maybe back here in 2015, and this stock had a really nice run up, went up, quite a bit, all the way up to about 90 some odd dollars, but it's come crashing down here. It's traded sideways here for about almost a year. We can see here the 52-week low, probably call it the COVID-19 low, was right at 20, and we're approaching actually a 52-week high. So the stock has nicely recovered, but it is kind of trading sideways here. Now, the Kraft Heinz company, we're all familiar with. We're all familiar with some of these brands. We might eat them on a regular basis. We might eat them on a semi-regular basis, but we're all familiar with these brands. But one time, a very smart investor once said, I think it was Warren Buffett, I could be mistaken, but I think Warren Buffett made the comment, and it might have been about Kraft Heinz, how at one time, building up this many brands was super powerful, and it was a big moat to the business because it costs a lot and it takes a lot of relationships with grocery stores and distributors to get this kind of distribution in this many brands. Well, today's different. Okay, you can get to the top of Amazon and build a brand on Amazon virtually overnight. And the same probably true with maybe Walmart.com and some of the other .com places. So having this many brands at one time was a massive moat and made stocks like Kraft Heinz very, very valuable. Now, I'm not saying totally discount it, but I'm just saying change your perspective a little bit on this kind of big brand building, because now brands are being built virtually overnight because of sites like Amazon and Walmart.com and others make it, and using Facebook ads and stuff like that make it a lot easier these days. Now, the other thing I want to take a look at is this is paying a pretty nice yield, 5.34% here. That's pretty nice yield considering where the treasuries are at today, basically zero. So you're getting paid to hold this stock. So it does give you a little bit of margin of safety. If, say, you buy it at 30 here and it ticks back down to 20 to 25, well, at least you're getting paid 5% on your money there. But what we'll talk about probably towards the end of the video is how safe is this dividend? Is Kraft Heinz making enough money to pay this dividend? We'll talk about that in a minute. First thing I want to do, though, this is a 10K report, their latest one. I've jumped down to page number 60 here. What I do is I always like to just kind of bring a broad perspective to what's going on with this company. So we're going to look at this top line number here, this net sales, and then we'll come down here to bottom line here at net income. What's been happening is you can see very, very steady. Typically with these like consumer packaged goods companies, you're not going to experience a ton of growth, but you're very steady on the top line. I mean, this is dead flat, basically, but we've noticed from 16 to, 16 timeframes here, but it's declined here. Top line's fine. Top line is absolutely fine. And if we look at gross profit, it looks like margins have ticked down down just a little, just a hair, but not a whole lot. Let's come down to net income here and see what's going on here. We'll come down to, I guess, right. We'll come all the way down here to net income here. Okay. So notice it was positive here. Okay. And it had a really nice resurgent up in 2017. That's probably reflective of this nice little $90 a share price here. So we ticked up, we virtually tripled net income here in a year. But then look what happened. Came negative here for 2018. So that's when you started seeing this pretty rapid decline in share price. This is what happened. Okay. Top line, fine. Gross profit, gross margins, fine as well. But profit slipped for a number of different reasons. It looks like they slipped to an operating loss here. Looks like they have this intangible asset impairment loss here. So they're taking this off. They're taking this goodwill. Notice these didn't repeat, or they were very small here. This is like a lot of money here. So that's what contributed to this net loss. Now, these might not repeat. These might go away. If you're betting on that, it might actually be a positive that they go through these impairments, they restructure, they do whatever they need to do, they clean up the balance sheet, and then things return back to normal. This top line starts growing. So now that you have that in your mind, you're saying, okay, well, top line's been fine. Okay, this is up until 2018. We'll take a look at a little bit more current numbers here in a minute. So we'll jump into, this is for the first 3 months ended 2020. So the most current quarter. And we're looking year over year here. This is last year in 2019. This is this year in 2020. These figures are in millions, so you got to add a couple zeros here, 6 to be exact. So we have net sales here, ticked up nicely. Okay, year over year, you like to see that. Okay, nice tick up here. Gross profit. This is what's interesting though. Notice that gross profit actually ticked down. So we had a tick up of net sales, but gross profit actually ticked down. That's showing you that these cost of goods has risen for whatever, maybe energy costs or transportation costs or advertising costs, whatever it might be. This has ticked up. And so that's not necessarily a good thing because we rose sales, but our, gross profit actually dropped. So that's a problem. That's something that you want to keep an eye on going forward. They have more, excluding impairment loss here, we have more of these goodwill impairment losses. So although it's less than the prior year's period, we still have this going on here. We got SG&A here. Tick down. You like to see that. That's nice. That might be due a little bit to maybe some kind of restructuring. Maybe they're laying people off. I don't really know. So now we come down to operating income. Strong operating income gain here, partially due to because our goodwill impairment loss was a little bit less than the prior period. As we saw here, gross profit ticked down. That to me is what stands out here at the top of this statement of income here. Moving down a little bit, we got interest expense. That ticked down. That's probably a good thing. Might be a sign of interest rates coming down a little bit. We've got, let's just flow all the way down. We've got some income tax and some other stuff here. We'll flow all the way down to this net income here. Notice that also ticked down. And as we saw here, that is what really, in my opinion, probably drove down this share price. Is this once very profitable company started losing money on a yearly basis. This was back in 2018. And we can see that it happened again here. And that's not, they turned a profit here, but we're seeing profits decline year over year. That's, something to be concerned about. Even after we took a less, almost $400 million worth of an impairment loss off the books there. So, not great. Okay. Shares outstanding are staying relatively steady, which is good in general for the common shareholder. So let's move down to this is adjusted. So if you want to say what the biggest thing here is they put these impairments back in. So we have our net income here and they start adjusting for net. So this is their adjusted EBITDA. So we saw up here, their net income was here. Well, Kraft is trying to tell you that, well, if you didn't count these impairment losses and you didn't count the equity awards and you didn't count depreciation and some other things, well, we really cleared 1.4 billion and it's really flat year over year. I wouldn't really pay too much attention to that because obviously investors aren't really paying attention to it. Now, there's other stocks out there, and we'll probably cover a few on the channel, where the shareholders and investors look at the adjusted number. In this case, I honestly don't think they are. So let's keep moving on to more adjusted numbers here. I'm not going to pay too much attention to those. Whenever you see adjusted numbers, what I would always do is just go look at the stock chart and see how the stock is reacting. Is it reacting to the adjusted numbers, or is it reacting to the net income number? And I think in the case of Kraft, it's accounting to like the GAAP numbers and not the adjusted numbers. So moving down here to a balance sheet. So we saw, take a look at this. This is actually year end. So always check your period. Okay. Before we were looking year over year. Now we're looking year end to current quarter. So this is only about 3 months here. And we see cash and cash equivalents tick up really big. Okay, these numbers are in millions. So that's a $3 billion tick up. Now, considering the company only cleared what, like 300 million in profits. So you know that this tick up is likely due to some kind of equity raise, some kind of debt, some kind of revolving credit facility. We'll find out here in a moment what happened here, what drove this massive increase in cash, because it certainly didn't come from the business, at least from a net income perspective. Everything else here looks pretty solid. Now, inventories you expect with this kind of company, with these kind of brands and the demand and stuff, it stays pretty steady. Now, with COVID and stuff, they might see an increase with grocery store traffic ticking up, things like that. And they might see, a tick up and might, impact inventories, not necessarily in a negative way, but in a positive way. Going forward. So we'll see. That actually will be really interesting because this has barely any U.S. COVID. Most stores and, we really didn't start seeing the shutdown hit till mid to late March. And so it'll be interesting, like the next quarter for Kraft Heinz, what happens there. See if they see this big boost that we've seen like in grocery store traffic and people eating at home and not eating out and things like that. So moving through this, we see total current assets here actually ticked up rather nicely here from really just 3 months ago. But again, I believe it's not due to operating activities. It's more due to some kind of investment or financing activities like borrowing money and things like that. Now, total assets stayed about the same. The one thing I want to show you here is we have these huge numbers at goodwill and intangible assets. And we've been seeing that this company has been writing down this goodwill number, pretty regularly here, at least on the year over year period. So what I would say is you could discount this a little bit here. You could always discount inventory and things. I don't care what business you're really looking at. So, but whenever I see a company with $105 billion worth of total assets, and what's this? This is like almost $80 billion. So like almost 80% of their total assets is in goodwill and intangible assets. Now, some of the brands that I showed you earlier certainly have some brand value that is hard to recognize, from a perspective, from cash or inventory or things like that. So certainly can understand this, but this goodwill, I don't know. I would discount this a little bit. I think investors are doing that as well because obviously the company has been discounting this quarter over quarter as well. Moving on. So now let's try to dig into in the liability side, like where did that $3 billion worth of cash kind of come? We churned out about $3.2 billion worth of cash. We know that the business didn't really make that much. So what we're looking for is some differences here in the numbers, and they all look about the same. Here's the current portion of debt. So this is how much they owe. But notice here, long-term debt actually ticked up from 28 billion to about 31 billion. And so that to me is probably where this cash equivalents ticked up here, is they actually either withdrew on a credit facility or they withdrew on some kind of long-term debt facility that ticked this up by 3 billion. That goes into the cash pile. So that's where that money came from. Not a bad thing with interest rates where they are, not necessarily a bad thing. I'm just taking note of that. Liabilities ticked up again, about $3 billion here. Again, most of that is attributed, I believe, to this long-term debt. Moving on, cash flows. This is probably the most important thing and a new thing, actually, I've probably taught you guys here on the channel is we've got a statement of cash flows here. So we pull down that net income. We come all the way up here to net income, past the adjusted numbers. We find the net income number. We pull that all the way down here. And again, we want to look at our periods. So here's year ago period, current period here. So we made 381. That's 381 million. And we start adjusting that number and start, taking stuff out. We start adding stuff back in, and we get down to this net cash provided by operating activities. This is really like what cash was generated by the business, okay? Not that all this other stuff doesn't count, but by just operating the business, if you take away all this stuff, kind of discount it, here's what was generated by the business. Not always an important number, and it's quite frankly, it's not too far off from our net income number up here, but it is, very significant here because what I want to show you here, two things actually. Here's our proceeds from our revolving credit facility. Notice here's where a lot of our cash went to the balance sheet. We noticed there was about $3 billion onto the balance sheet. Okay, they paid this here's a payment on a long-term debt, and they paid this dividend here of $488 million. So that left us with cash here of about 3.1. We saw that cash increased by 3.1. Notice this is net increase in cash and cash equivalents. 3.1, it was due to here, right here. Okay, this $4 billion was pulled from a credit facility. Okay, they had to pay a little bit on long-term debt. They had to pay a dividend as well. You can pull forward this 212, and that gets us to a net increase of this $3 billion. Obviously, most of it attributed to borrowing money. Now, here's what should stand out to you. The business netted $212 million in the quarter, and they paid investors $488 million. Okay, let's look at the prior period. Okay, this is the prior period. The business generated $304 million, and again, they paid investors $488 million. Think about that. Think about if you made $1 at work and then you went to the store and spent $3, well, you'd be at some point underwater. And I'm not saying that's going to happen with Kraft Heinz, but that's what I see here. I see a 5% yield here, but two things. I'm not super confident that they're going to be able to keep paying this high of a dividend. And I'm definitely not confident at the current moment, the current state of financials, that they'd be able to grow that dividend, which I think is two important things. And you'll actually see, I'm not sure the dividend is safe. There's others, there's other articles here. So there's other investors that are seeing the same thing that I am, that this dividend is not necessarily safe because they're paying $488 million and the business itself is really again, we can come up to this net income, $388. That's $100 million deficit just on the dividend. So that is something I would be concerned about. I wouldn't be running out and be scooping up Kraft Heinz shares primarily because of that, because that dividend is a level of safety, okay? I think there's a lot of investors that are buying this stock in part because of this dividend. If this dividend gets cut because the company is not generating enough cash to cover it and they're having to actually borrow money to cover it, then there could be a much steeper downswing here. Now, buy, seller, hold Kraft Heinz. That's about what we have left in this press release. Okay, from a top line perspective, this company is about the same. They're generating the same kind of sales. Two things that I would look for before I bought Kraft Heinz shares. I'd want to see this gross profit start to tick back up because, like I said, we grew here a little bit on the top line, but the gross profit actually dropped because our cost of goods sold ticked up. Now, is this recurring? Is this going to happen every quarter? Is this going to happen, only in the March quarter? Those are things you'd want to investigate before you kind of went in and bought a bunch of shares of this. Also, again, the second thing I'm looking for is how is this company going to cover this dividend? Because I believe there's a fair amount of investors that are buying into this stock because treasuries are basically zero, but you can buy a stock like Kraft Heinz and get paid 5%. So those are the things I would think about. Okay, obviously also with this 5% yield, it does keep short sellers away because they have to pay that dividend unless you're doing it through maybe the options market or something like that, which probably most people would do. But those are the things I would say. Also, I see this stock has traded sideways here for a while, since about 318 of last year all the way till this year. So it's traded sideways. Obviously, you could have came in here and bought it in the the low 20s and been up a little bit. I don't think I'd want to play it that way. This type of stock is more of a buy or hold. If you want to trade, I don't know why you're reading financial statements. Honestly, I would just study price action. But for you buy and hold guys, I would be cautious with this one. Okay, if you already own shares, say you bought over the last year, you're in for about 30, shares are at 30, what I would do is I would put a stop loss underneath my shares. You can pick whatever you want, maybe $25, you could pick $20, pick the coronavirus low of $20. But I would put a stop under here just in case Kraft Heinz comes out with a press release and says, hey, we got to cut our dividend from $1.60 down to, really, they need to cut it probably more than in half. They need to cut this, quite frankly, they need to cut this by about maybe 70, 80%. That would be quite a hit on this dividend. I think it would hit the shares quite a bit, maybe more than that. It might breach that $20 mark. So if you're in this stock already and you want to hold, I got no problem with that, because if this dividend turns out to be safe, they can finance it through really cheap money and cheap debt. I got no problem with you holding these shares and getting paid a little bit of money, but I would understand your risk and mitigate it by getting some stop losses underneath those shares, or you can do stuff in the options market or whatever to kind of protect yourself from the downside of it. That's what I would do. I certainly wouldn't be jumping in here and going long until, like I said, I saw that gross profit margin start to turn around. That's what I'd want to see before I really got excited about this, because this gross profit here is what's going to drive that dividend coverage and then eventually kind of dividend growth as well. And also you kind of want to see this goodwill impairment start to turn around in the other direction. So for me, if you're in this stock in this $30 range, I got no problem with you holding it. I think that's fine. If you're not in this stock, I say you hit it, put it on your watch list. Take a look at what's going on here. I don't think you're going to see massive moves just based on what I'm seeing here. I don't think you're going to see a massive move to the upside and just miss it from going from 30 to 60 in the next 12 months. I don't see that happening, because that's just not the nature of their business. It's a super steady. We just saw that they did like 24 million, 25 million, in a year. And that's about what they're on pace for here with this kind of quarter. So you want to see this gross profit tick up. You want to start seeing that net income tick up, and you definitely want to see them have enough cash to cover that dividend in the future. So hopefully you guys enjoyed this video. Couple new things, including dividend coverage there. If you've got a stock you'd like me to cover here on the channel, leave me a comment. I'd love to hear from you. If you got any comments or questions, leave them below. If you like what we're doing here, consider subscribing to the channel and hit that like button if you've enjoyed what you've seen. Thanks so much for tuning in. Have a great day and good luck with your investments.